Hello everyone, my name is Nelson Rima and I'm your forex coach. This is part 2 of our first introduction video, and in this lesson we'll be learning when do I trade forex. In our last lesson, remember we talked about forex. We defined forex as foreign exchange. We talked about the major participants in the forex market. We talked about the banks, we talked about the central banks, we talked about the hedgers, the speculators, we talked about the retail trader, which is you and I, who trade daily on the forex market. And then we move on to talk about major currency pairs. Then we talk about the crosses. We said we have 8 major currency pairs. We said we have the euro, we have the dollar, which of course is 85% of trades. We have the euro, we have the Canadian dollar, we have the Australian dollar, we have the Swiss francs, we have the Great Britain pound, and then we have the JPY, which is the Japanese yens. So those are the 8 major currency pairs that have been traded with the highest volume in the foreign exchange market. So today we'll be looking at when do I trade forex. Now you'll be asking, is it every day you trade forex, or is it once a week, or how do forex trading go? So in this lesson you are going to be learning that. So let's go into the lesson. Alright, so when do I trade forex? There are a lot of things. There are some basic things you must consider when you are thinking of when to trade forex. One of which is going to be the liquidity. We're going to talk about liquidity, we'll talk about spreads, we'll talk about volume, we'll talk about volatility. These 4 things are key. You need to understand them and how they work in the forex market. You need to know how they work. You need to know what they mean. So basically, when we talk about the first one, which is volatility, we're talking about when the market conditions begin to change rapidly, when there is frequent buying, frequent selling, when there is high volume of selling, high volume of buying. So the market changes rapidly and it changes at different times. There are some times that there's going to be high volatility in the market, which means there are going to be big moves that will take place because of maybe there's going to be major news releases. Maybe a news came up in a particular country about an inflation that can actually reduce that can increase the volatility of the currency pair you are trading. Then we talk about the trader's paradise, talk about trader sentiment. All of these things increase and reduce volatility. We talk about times where there is low volatility, meaning there is not much movement in the market. So at that time the market is sluggish. Maybe there's no major news release, and traders don't like the current happenings in the country, in the particular country they are trading on. So they might want to keep clear from the market. So there are times where there's volatility in the market. Market conditions are high, there is high hopes, and there are some times where there is low hopes. So people tend to put in their money when there is more volatility, because that is when big moves happen. That is when the big banks do their trading, and that's where you can get clear cut trades that can hit your take profit levels. So that is for volatility. So we'll move on to the next one, which is spread. We'll talk about spread. Spread is more or less the quote of the currency. It is the amount with which the base currency is being sold, and also the amount with which the quote currency is being sold. So the spread is basically for the broker. It's not stable. It's determined by the broker, who is giving you access to enter into the market. Okay, so for example, you can see that we normally sell the base currency and we buy the quote currency. So when you arrange a currency pair like this, for example, this is the euro and this is the USD. These are a pair that we are about trading. Now you can see that the euro is at 1.0860 at this time, and the USD is at 1.08674. Now the difference between this quote, this number here, and this number here is what we call the spread, and it's the broker that determines the spread. Okay, the broker determines the spread for each currency pair that you will be trading, because they give you the access into the market and they have their own prices. Okay, they have their own prices. So the spread is more or less the price of the base currency or the price of the quote currency. Of course, when you minus it, it becomes a pip. That's where that's where we have a pip. For example, you see 1.4 pip spread. So the difference or the distance between the quote currency, the base currency, and the quote currency in the currency number, that is what we call pip. Okay, the rate at which the currency is being sold or bought at that time, the rate of the particular currency, the rate of the currency at that time minus the rate of the currency of the base currency and the rate of the quote currency is what we call the pip. When you minus it, it's what we call the pip. So the pip, the spread, so we get our pip from the spread. Okay, so the spread is different in price between buying and selling the base currency. So when we sell, the difference in the prices when we buy or we sell the base currency, that is the spread, and it's determined by the broker. So we'll talk about liquidity. Now we'll talk about liquidity. We're talking about when there is much participant in the market, or rather when there's money in the market, and there are times when there is no money in the market. So it leads us to the high volatility, and that determines the high volatility and the low volatility, low liquidity, and high liquidity in the market. Liquidity has to do with when there are participants, market participants, who are actually trading high volumes. Okay, when there's much volume of trade going on in the market, that is when we can say there is high liquidity or there is low liquidity. So there are particular times when the market is liquid, and also particular times when the market is not liquid. For example, in holidays, during holidays, the market is not liquid. Many of the banks are closed. Many of the major movers of the market are not there. So there's no liquidity in the market. And when there's no liquidity, the market tends to move in opposite directions without a clear-cut movement. Okay, so that is for liquidity. Then we talk about volume. Volume has to do with market participants doing large numbers of trades in certain currency pairs. You know, every currency pair has a time where there is high volume. Okay, for example, when the market is opening, you don't expect high volume. It's at maybe 2 hours into the market open, that's when you begin to see high volume trades, and that is when major participants are in the market. So there are times where there's low volume, not many orders happening, holidays occur, end of London session, beginning of Sydney session. When the session is ending and when the session is starting, there tends to be low volume. Okay, low volume. So now let's look at another area. We'll look at the 4 major sessions in forex trading. Remember, we are talking about when do I trade. Okay, so we'll look at basically 4 things that we must understand before we determine when to trade. We'll talk about the spread, we'll talk about the liquidity, which is the amount of money in the market. We'll talk about liquidity, the difference in buying and selling, that is the bid price and the ask price, the selling price and the ask price, the amount that sellers are willing to give in contract. Okay, then we talked about volume, the volume of transactions going on. Then we talk about the volatility of the market, how the market is changing rapidly. Is there movements in the market, or there are no movements in the market? These are some of the things we must consider before we take any trades. Then another area we must look at is the forex sessions. So there are 4 main forex sessions that we must consider before taking any trade. So we'll talk about the Sydney session, which opens, which is the first trading session of the day. Then we'll talk about the Tokyo session, which is the second session, the London Open, which is the third session, and the New York session, which is the last session every day These 4 sessions take place every day of the week from Monday to Friday. Okay, so the Sydney session begins the trading day. This is where the trading officially starts in the first market. It is the smallest and the calmest of the major markets. And now there are currencies that move at this particular time. We talk about the Australian dollar, the New Zealand dollar. These pairs move initial, they have initial volume of movement at this session of trades, because this is the time when the country is awake, their market is moving, and there is volume in the session. So these currency pairs move the most in this session. So it's known as the Australian market. Many people call it the Australian market. So it's the Sydney session, and trading begins by 4 p.m. That's of course 1 a.m. Eastern time, but in GMT in Nigeria is 6 a.m. GMT, but according to our Nigerian time, that should be 11 p.m. in the night. 11 p.m. on Sunday night, 11 p.m. trading starts. The Sydney session starts by 11 p.m. on Sunday night. So that is for the Sydney session, and those 2 pairs are the ones that move the most. When I mean move the most, meaning there is volatility in these pairs at that time. There is trading volume in these pairs at that time. The next session is the Tokyo session, which is the second session and the 3rd largest forex trading center in the world. And the pair that moves most in this session is the Japanese yen, which is the 3rd most traded currency in forex. Okay, so it has to do with part of Asian session, which is the Sydney session and the Tokyo session, that forms the Asian session. Generally, there is low liquidity and volume, and there is higher spreads. Higher spreads because people don't like trading this market often. So the brokers increase the spread margin. They increase the ask and bid and ask prices. Okay, so that they can actually make more money at the time, because there is low liquidity. Remember, we talk about liquidity. We're talking about how the market is moving. What is there money in the market? So the more money there is in the market, the lower the spread. The lesser money in the market, the higher the spread. And also, the lesser the volume, the higher the spread. The more the volume, the lower the spread. So the next session is the London session. The London is the 3rd most traded session in the forex market, and the pairs that move most in this session are the GBP, the Great Britain pounds, the Euro, and the CHF. Okay, so historically being the center of the trading, this is a major session in trading. 35% of all forex transactions take place in this session. Is the most active trading session. Then in this session, there is high liquidity, there is high volume, the spreads are low because there is liquidity, there is volume, so everything is high, and there are major releases at this time. The news comes up and they move the market north or south, go long or they go short, they sell the market or they buy the market. So in this first session is close to the last session of the day, and it starts by 7 a.m. in the morning. London session begins by 7 a.m. in the morning at Nigerian time. Okay, so that is for that. Then the last session of the day is the New York session. 85% of all trades involve the USD. Big moves take place during the New York session. There are major news releases or call to, and the pairs that move the most are the USD, United States dollars, and the Canadian dollar pairs move the most. Volatility dies down by 12 p.m. So by around 11 p.m. in the night, 10, 11, there's no more volatility. There are no more buyers and sellers in the market. So the market tends to drop. The volume of the trades tend to drop, and that affects the volatility of the market. So basically, these are the 4 trading sessions, and you must be aware of their time of trading. You must be aware of when to trade and when not to trade. Okay, because that's what we're discussing. When do I trade and when not to trade. So in trading, you must understand, first, basically, you must understand the time of trading. You must understand the pairs that move the most. Remember, we talked about 8 major currency pairs. You must understand when those major currency pairs move. Okay, when they have the 4 characteristics that can enable us to trade. Number 1, we talk about the volume, we talk about the volatility, we talk about the liquidity, we talk about the spread. Is the spread increased or is the spread low? Can I enter the market with this spread? Am I ready to buy it at this price, the current price? Okay, so these are the 4 things you must look at. And looking at these 4 things, you have to consider the trading sessions. The trading session. We talked about the Sydney session, which is the start of the day. We talked about the Asian session. We talked about the London session. Then we talked about the New York session. These are the 4 basic sessions of trading in each day. And the first session starts by 11 p.m. Nigerian time, and the last session starts by approximately Nigerian time 1 p.m. okay, till about 11 p.m. in the night. So basically, that is how trading sessions are arranged. So now, what is now the best time to trade? Okay, so you ask this question, what's the best time to trade? Your answer should be that the best time to trade is when the market is liquid, when there is volatility, and when there is high volume. So at this particular time, there are big moves in the market, and you can easily make money while trading at these times. So you need to know the sessions of the trading, trading sessions. You need to know the pairs that move the most at that time. Then also you need to know what is happening in those economies or in that country currency you want to trade. Okay, with that you can know if there are going to be big moves of news release, which of course increases the volume of trade, volatility in the market, and also helps to increase the liquidity of the market. So that is for that. So majorly what we are doing in the forex market is buying and selling, and in buying and selling is represented by 2 animals. We talk about the bulls for buy, we talk about the bears for sell. When the bull is fighting, it fights up with the horn, and when the bear is fighting, it fights down. So there are common terms you need to learn when you talk about trading. When you talk about buy, when somebody says long, I'm going long on the currency pair, it means I'm buying. Long means buy. When the currency value is expected to rise, you would want to place a buy. Remember when we started this lesson in the first introduction, we said we buy low and we sell high. So we buy, we sell, we go long, we go short, we go bull, we go bear. Okay, so we buy low and sell high. So to sell means to short. So okay, I'm shorting Euro USD, meaning I'm selling Euro USD. Okay, it's just a word. Then when currency value is expected to fall, you would want to place a sell. So those are the 2 basic things we are doing in the forex market. So we observe the trading time, we observe the market condition, then also we determine whether to go long, which is the buy, when the currency is expected to rise, or we go short when the currency is expected to fall. All of these culminate into what is called analysis. Okay, now in analysis we have different types of analysis, which of course we will handle in our next class. So this is the end of this lesson for today. In our next topic, we're going to be looking at our charts. Then we'll be looking at how we can set up our MT4 and start trading in the market right away. So thank you so much for this lesson, and stay tuned for the next class.